In the last lesson, we talked about net volume. It helps us see which side is more aggressive, buyers or sellers. But today, we're going one step more basic. When you see volume rising, how do you know if it's actually high? A candle may look like it has big volume, but compared with what? Compared with yesterday? Last week? The last 20 candles? That's where volume moving average, or VMA, comes in. It doesn't tell you price will definitely go up or down. What it does tell you is whether the current market activity is above normal, below normal, or just average noise. Follow me, and we will keep watching the market together, not chasing emotion, but breaking down the logic. Don't forget to like, share, and bookmark. What is VMA? Let's define it first. Volume moving average, or VMA, is simply the moving average of volume over a certain number of periods. For example, a 2-0 period VMA takes the volume of the last 20 candles, adds it up, and divides it by 20. On a daily chart, that means the average volume of the last 20 days. On a 1-hour chart, it means the average volume of the last 20 hours. So the main job of VMA is not to predict direction. Its job is to create a normal volume baseline. Without VMA, you might look at volume and say, yeah, that looks pretty big. With VMA, you can say, current volume is clearly above its recent average. That's a much better way to read the market. The true value of VMA. A common beginner mistake is only looking at whether the volume bar is tall or short. But volume is not an absolute game. It's a relative game. You can't directly compare Bitcoin's volume with the volume of a small altcoin. You can't compare bull market volume with quiet bear market volume either. Even for the same asset, normal volume changes from one market phase to another. That's the real value of VMA. It gives volume a reference point. If current volume is above the VMA, market participation is stronger than usual. If current volume is below the VMA, interest is relatively weak. If price is moving, but volume stays below the VMA for a long time, that move deserves some suspicion. How to use VMA? There are 3 common ways to use VMA. First, use it to check whether volume is truly expanding. If the volume bar clearly moves above the VMA, that tells you market participation is actually picking up. Second, use it to judge breakout quality. If price breaks above resistance and volume is above the VMA, that breakout has more weight. But if price breaks out while volume is still below the VMA, be careful. Price may have moved, but the market may not be fully behind it. Third, use it to read trend support. In an uptrend, if rallies often come with volume above the VMA, buyers are showing real participation. But if price keeps rising while volume keeps fading and stays below the VMA, that rally may be running on thin fuel. Continued from the previous issue, how do VMA and net volume coordinate with each other? Now let's connect this with the last lesson, net volume. Net volume answers the question, who is more aggressive? VMA answers the question, is participation actually higher than normal? When you combine them, the picture becomes much clearer. For example, price breaks above resistance, volume is above the VMA, and net volume is positive. What does that tell us? First, participation is stronger than usual. Second, buyers are the more aggressive side. That's a higher quality breakout. But if price breaks above resistance, volume is above the VMA, and net volume is negative, things are more complicated. The market is definitely active, but selling pressure may also be strong. Price may have pushed higher, but sellers could be waiting above. Another example, price drops. Volume is above the VMA, and net volume is clearly negative. That's not just a quiet pullback, that's active selling pressure. But if price drops while volume is below the VMA, and net volume is not strongly negative, the move may simply be a low interest drift, not a strong downtrend. If you followed the series up to this point, you'll notice something. Volume indicators are not about adding more lines just to make your chart look smarter. They're about reducing guesswork. A lot of traders don't lose money because they can't see price moving. They lose money because every little move feels important. VMA helps you slow down and ask a better question. Is this move actually attracting more participation than usual? How to select the parameters. Common VMA settings include 5, 10, 20, and 50 periods. Shorter settings, like 5 or 10, react faster. They're useful for short-term traders who want to catch recent changes in volume. The downside is that they can be easily distorted by one unusual volume spike. The 2-0 period VMA is a popular middle ground. It's not too slow and not too jumpy. On a daily chart, a 2-0-day VMA roughly represents the average volume over the past trading month. A 5-0 period VMA is better for reading the broader volume environment. It reacts more slowly, but it filters out a lot of short-term noise. There's no perfect setting for everyone. The real question is, what time frame are you trading? A 5-minute scalper and a daily swing trader should not read volume with the same rhythm. Let's go through a few common mistakes. Mistake number 1. Volume above the VMA means bullish. Not necessarily. Higher volume means higher participation. It does not automatically mean price should go up. High volume during a sell-off can be very bearish. Mistake number 2. Volume below the VMA means there's no opportunity. Also not true. Low volume can mean the market is quiet, but quiet markets can build pressure. A long sideways range with shrinking volume followed by a strong volume breakout can be very important. Mistake number 3. Treating VMA as a buy or sell signal. VMA is not a button, it's a filter. It helps you judge whether a price move has volume support, but it doesn't make the trade for you. Mistake number 4. Ignoring news and events. Sometimes volume jumps far above the VMA, not because of a clean technical setup, but because of news, data, or a macro event. In that case, don't rush to force a textbook pattern onto the chart. First ask why the market suddenly became active. Let's wrap it up. VMA, or volume moving average, gives volume a baseline. It doesn't predict price direction, but it tells you whether current volume is above normal, below normal, or roughly average. Just remember 3 things. First, VMA is the baseline for volume. Second, when price breaks out and volume is above the VMA, the signal usually carries more weight. Third, VMA should be used together with price structure and net volume, not as a standalone trading signal. From net volume to VMA, we're really training the same skill. Don't just ask whether price moved. Ask whether there was real participation behind the move, how strong that participation was, and which side was more aggressive. Once you start reading volume this way, the chart stops being just a bunch of candles going up and down. It becomes a map of market behavior. In the next lesson, we'll keep breaking down volume-based indicators. And over time, you'll see that better trading decisions usually don't come from one magical indicator. They come from understanding price, volume, and market structure together. This content is for technical analysis education only and does not constitute investment advice. See you in the next lesson.